as a financial advisor that has a YouTube channel, one of the questions my viewers ask me is, hey Asul, can we dramatically simplify this whole discussion on retirement planning? Do I have enough money to retire? How do we make this as simple as possible so that I can make the decision myself as to whether or not I'm ready to retire? And so I've got a deal for you today. If you give me a couple seconds to flip the burgers on the grill here, let's go for a walk and I'll share with you what I consider to be the world's simplest financial plan. So give me a second here as I flip these burgers, and let's think about, what is the essence of what we need to have in order to make a good decision on this. So I'll leave these burgers out here. Let's go for a walk. I'm going to hope that the birds don't give me a surprise and eat my hamburger buns while we go for a quick walk and talk about this. So at its core, the essence of do you have enough money to retire really begins not with your bank account, but with your checking book. And what I mean by that is, how much money are you spending in retirement? How much money would you like to spend in retirement? And again, we're simplifying things here. So look at what you're spending, and then you have to make some assumptions. You have to do some guessing and think through, what am I going to spend in retirement? A rule of thumb for a lot of folks is they're going to spend 80% of what they spent before they were retired. So if you take your take-home pay and you subtract away from that your savings, because when you're retired, in theory, now it's time for us to start spending that money. So let's say you're making $80,000 a year. Let's say that you're paying taxes, I'm just making up a number, of $20,000 a year. So your take-home pay is $60,000 and you're saving $10,000 a year. So you look at that and you say, okay, that's $50,000 a year, which is easy math for me. So I'm gonna hold on to that number at $50,000 a year. Now, it's gonna change, right? There's these go-go years, there's the slow-go years, and then there's the no-go. But today's video is about making this as simple as possible. So what does that spending look like for you in retirement? And then we just have to, make some guesses as to how consistent that's going to be. Some years there's going to be some major purchases in there, but again, let's just say that for the sake of argument, you're making $80,000 after taxes, after savings, you're at $50,000 a year. The next thing we have to look at is, do you have other sources of income? For many of us, that's going to be Social Security. And if you're at the age when you can collect Social Security, if you are planning on taking Social Security, that's going to be a source of income. For other people, they may have a rental property, they may be an owner in a business, they may have other sources of income. And so the simplest thing to do is just take that number, the amount that you want to spend, and subtract from it what those other sources of income are going to be. And so in our case, we're making $80,000 a year. Take home after taxes was $60,000. We were saving $10,000, so we said $50,000 a year. And let's say that Social Security is going to be $25,000 a year. The average Social Security check, I believe, is about $1,920 as I record this. So I think that's a decent estimate. So now we've gone from $50,000 a year to basically, let's call it, that would be about $25,000. So let's cut that in half, the $50,000. So now we need $25,000 a year coming from our retirement savings, because we've got half coming from Social Security, half of that $50,000. We've got the other half is going to come from our savings account. So now in this, the world's simplest retirement plan, we've got this need of $25,000 a year. And now let's say, where's that going to come from? It's going to come from our retirement savings. And so one thing to do, there's the 4% rule, there's a 3% rule, there's a 5%, but let's start with the 4% rule, which was developed by William Bengen in the mid-1990s. That assumes that your investments are going to be invested, some in the stock market, about 60% in the stock market. So the 4% rule, again, this is the world's simplest financial plan. So the inverse of 4% is 25. So 1 over 25 is 4%. So instead of taking how much money that we need each year and figuring out what the base has to be, the retirement savings, we're just going to take the amount that our retirement accounts need to deliver, which in this example is $25,000, and to use the 4% rule, we're going to multiply that by 25, which is $625,000. Now, there's some people would say, that's really conservative. I think I can spend 5% a year. I'm not saying me personally, I'm saying people would argue that you can spend 5% a year. So we would take that $25,000 and we would multiply it by 20. So in that case, we would need $500,000. So if we want to spend a little bit more, if we want to retire with a little less and take 5% out of it a year, we need fewer dollars in our savings in order to make that happen because we're taking a higher distribution rate. So at 5%, with $25,000 a year, we'd need $500,000. 5% of $500,000 is $25,000. And then, but there's also people that say, hey, Asul, that's pretty risky. Do you really want to take 4%? Do you really want to take 5%? And those folks might say, take 3%. And there is no right or wrong answer. It's the answer that's right for you. And so some people would say take 3%. So we would multiply how much money we want to spend a year by 33. So $25,000 a year multiplied by 30 would be $750,000. So that, if my math is right, is $825,000 a year. Now you just bring out a calculator. I'm doing mental math on this walk, but I'm pretty sure that's $825,000. So that is the world's simplest retirement plan. But this gets you in the ballpark. It doesn't give you the answer. And I think when you retire, think about it. If you've been working in your job for 10, 20, 30, 40 years, you want to have a lot of confidence that when you pull the trigger to retire, that you're going to be okay. And the more confidence and clarity you have, I think it gives you more sleep at night factor for yourself. So this is the world's simplest financial plan, but I caution you that I want you to have more clarity, I want you to have more certainty, and I want you to have more peace of mind. And so I think this gets you in the ballpark, but I encourage you to work with a financial advisor to think through, the things that a simple plan like this cannot capture. And one of the things I'll encourage you with is taxes end up being a significant expense for most retirees, and one that many of us don't think about until we're retired and we start getting the tax bill. Now, for the first time in many of our lives, when we retire, we can control our taxes for several years. And the reason is, when we had W-2 income, if we were working for an employer, we're getting a W-2 form, it kind of is what it is, what the taxes are that we're paying. But now that we're retired and we don't have the W-2 income, we have control, particularly if we have money in either a regular IRA or a regular 401k, what I call a tax me later account, because as we take that money out, that's going to be taxable income. And then if we also have money in a Roth version of a 401k or a Roth version of an IRA, that can be a, you taxed me before account, but don't ever tax me again on this money account, what I call a tax me never account, because we did not get the tax break when we put our money in. But now, the way the tax laws are written as I record this, you don't pay federal tax. It's not taxable income for you when the money comes out of a Roth or a regular IRA. So many of us are going to have that tax me later account, the tax me never account, and then finally what I call a tax me as I go account, which is the money you have in a regular bank account or a regular brokerage account where you're paying taxes on the interest and the dividends that you're receiving every year. You get a 1099 on that. If you sell a stock position, you're either paying short or long-term capital gains, what I call a tax me as I go account. Because we have those three accounts, for the first time in our lives, we really can control our tax rate. And the reason I mention all of this is we don't want the tax implication to be an afterthought. Most people can save thousands of dollars if they're strategic about how they withdraw money from those accounts. And the reason they can save that kind of money is the United States has 7 tax brackets, and they start at 10% and 12%. Then they jump up to 22 and 24%. And then they jump up again, I believe it's 32 and 34%, the last one's 37%. But we want to take advantage of those lower brackets. We want to fill in that 10% and that 12% bracket, which is a relatively low tax bracket for most of us. Many of us would be happy to pay federal tax at that 10 or 12% level. What we want to try to avoid doing is jumping up to the 22%. Now bringing this full circle to the financial plan, the world's simplest financial plan. So I gave you a way to think about it. And then I encourage you, yes, this gets you in the ballpark, but I encourage you to think about working with a financial advisor, preferably somebody that's a fiduciary to you 100% of the time. They always, 100% of the time, put your interest ahead of their own. People think that all financial advisors are fiduciaries to them 100% of the time. Unfortunately, they're not. But I encourage you to visit with a fiduciary financial advisor and or an accountant and go deeper into your retirement plan. And for many of us, the cost of that planner is going to be paid for by them helping us think strategically about our taxes. And even if it's not, I think it's an investment worthwhile. But I think many of you are going to find that the tax savings by being strategic is going to more than pay for that financial advisor to look at your plan and make sure that the world's simplest financial plan is going to work for you as well. Thanks for watching. I want to encourage you to look at this video up here where I talk about 5 reasons to retire as soon as you can. You know, unfortunately, when we're 60 years old, most of us have less than 1,000 weeks of healthy, active time remaining. I want you to get each and every one of those weeks. I want you to squeeze all the juice out of the youth of your senior years. So 5 reasons to retire as soon as you can. Thanks for watching this video, and I'll see you in there. Bye-bye.